So, just as a reminder, the purpose behind this is how do we attract more money into the plan so we can hit our supplemental retirement goals or quality of life goals or have money available? We need more money. We need to attract leverage. How do we do leverage in a safe way is the key concern here. So let's look at where we are with interest rates. The Fed has announced multiple interest rate rises this year, is planning, or the market's planning in multiple more rises over the next 6 months or so. And we know that there is a lot of speculation out there about where inflation is going. And everybody has an opinion, but nobody has the crystal ball that's perfect. So rates are going up. What you'll see from this chart is that historical interest rates hover around 4.6%. So that means in loan pricing, by the time you add the bank money on there, closer to 6%. We're not even close to that right now. So we've been lulled asleep, if that's the right word, by a low interest rate environment created for a whole variety of reasons. But our interest rate environment right now is not anywhere close to historical averages. Now, I make this point because when we were designing Kai-Zen, to assume interest rates stay low forever was just naive. So we assumed interest rates would go up, but we didn't know by how much, so we build quite a lot of buffer in, as we'll cover. But what we're really worried about, if you think about it, is how much will that lag bite us? So let's look at what happens here. We have an illustrated rate from some insurance illustration. We have a projected loan rate that's using, in our case, what we use is the interest rate forecast the banks themselves are using with the loan price added on. So we have a pretty good feel for that because the banks have a good handle on interest rates, or at least they feel they do. But the worry is this. Something happens. Whatever the trigger is, maybe it's something like in the early 80s where there was the oil crisis or whatever, interest rates suddenly go out of control. And so what people worry about is basically my loan cost getting above my policy return rate. Now, part one was to show you that over a protracted period of time, that is, unless the way the entire economy works just completely changes, in case we've got bigger problems, that's not going to happen over time. Now, I make the point and stress the point because we get a lot of people who haven't thought about this saying, well, what happens if my loan rate goes to 8 and my policy return stays at 6 in perpetuity? Well, they've just described the collapse of the entire economy, but they don't realize they've said it that way. But what we can have and should fear is what if there's a sudden snap in interest rates? So how do we address that? So what's going to happen with the IUL, we already know, is that over time in a lag fashion, the option budget will go up. And statistically speaking, that means that the caps will go up, which means my ability to capture the market upside goes up with it, but it will be delayed. And so if we look at that delay, what will happen is, let's say 2 years' time, that cap slowly starts to rise. As the market goes up and down, you still have the same number of zeros and same number of upsides, but I capture more of the up. Now, we like that because if you think about it, if the market crashes 40% because of the inflation woes and fears of the economy and everything goes wrong, market crashes. Sometime later, next year, the year after, market rebounds. Well, if we got a zero in the crash, we want as much of that rebound as possible. So if my option budget goes up, that's kind of cool, but it's delayed. So I'll call this period the risk premium squeeze, when my cost of loan has gone up by my ability, but my ability for the product to perform is lagging that. So let's look at this squeeze period, because that becomes crucially important that we build enough buffer to cover that base. Now, the two changes that we already know and tell people about is the Zens, Kai-Zen and Tri-Zen, have both built into them a buffer that accounts for a substantial squeeze, either created by a sudden rise in interest rates or a situation where, yes, I have a higher option budget, but I just don't get some good returns, so that more of like a depressionary environment. We've built both of those tests into the design already. So what we're really looking at is a short, sudden rise in interest rates. Now, If you go back and study the 80s, for those who are interested in interest rate history, which is probably none of you, all right, but you might get really interested now, right? Well, at least for 5 seconds. What we're looking at is how did that rate change happen? So if we go back to the 80s, what you'll notice is interest rates gradually rose through the 70s. You know, we were up at the 6% loan rate environment and everybody thought that was normal. And then there was a loss of control around the 80s when early 80s when it suddenly spiked up to 18%. The point I'm making here is that rise in interest rate took 10 years or more to happen. And then it took 30 years to de-escalate, right? So we know it doesn't happen overnight. We also know at that time, if you had a bond portfolio, they were throwing out 15, 16% rates of return. And for those of you who remember back in the old days of universal life vanishing premium, the problem was we would get 12% return on our bonds forever. Well, that was naive, right? And we're not going to make that mistake again. But what we do know is that in that environment, all the fixed income guys who run the general accounts of the life insurance company would be licking their lips because they'd be buying new bonds at 15, 16% yield, certainly over 10%, and that would drag the portfolio rate up. So what do we actually do in our stress test? Well, the first thing we do is we don't take 10 years for that to happen. Interest rates go from where they are today to 18.1% tomorrow. Now, I'm going to argue that would be kind of cataclysmic on the economy, but that's what we built into the design. The other thing that we built into the design is the portfolio rate. Those bonds inside the general account do not change their rate of return for 4 years. So a substantial delay. It means that those fixed income guys who are changing 12 to 15% of their portfolio every year fell asleep for 4 years and did nothing, even though in reality 48% of their bonds would need to be replaced. Now, if I changed 48% of my bonds in that environment, my portfolio rate would be above 10%. So after 5 years, we allow them a 1% increase to around 5.5% portfolio rate. In other words, they would all been fired, hung, drawn, and quartered, and thrown out to dry because they'd just done the god-awful job. And these are highly, highly professional guys, so that's not going to happen. But in the test, we actually suppress the ability of the bond portfolio to go up above 5.5% forever. It never, ever gets up there, even though our rates stay up from a loan point of view. Now, we're doing this for a reason. We want to see if we break the loan. We know that over time this recovers, but we're just putting a squeeze on that premium that has never happened to really make sure we build enough buffer into the design. Too often in the financial services industry, people cut corners to look good. This is designed to be a safety net. So we don't want to just not cut corners. We want to give them a nice swing, wide swing, so we got plenty of safety in it. So what this means is we built a safety net into this plan that is more than accommodating the worst interest rate period we've ever seen in US history. So that's a good thing, right? So just to put some numbers on that, here's our stress test data that we publicize. That has been validated by multiple people to make sure we're doing it correctly. Actually, they tell us because we're over stressing the design, that this is conservative even for an 80s design. Now that's built into the design that you're considering or looking at in Kai-Zen or Tri-Zen, right? So that's there. But it's there for a reason, which is safety net. We're not trying to have the fastest car in this regard. What we're trying to have is a battle tank that can take any hits and dings and whatever, right? So it's designed to be a safety net. So in other words, we don't just build it in. We have it there as a safety net, but we show it. And so here's just an example of one of our proposals, where I just took one at random. We show you the expected outcome and how that is reflective versus your alternatives, but we're also showing the 2 test results on every single design, so you know what they look like, even with the conservatism that I've mentioned in there. Now we do this because we're in a highly regulated industry, and we are not allowed to show the illustrated rate growing over time above where it is today. So we're showing a test that shows no response in effect in line with the test that we're actually running and I mentioned. So what does this all really mean? Right now, because of the regulatory environment, we're already showing the normal situation where the expected risk premium is being suppressed by over half. So we're already in a position where we're showing half of what's ever happened over the last 30-year history. Take that back to 1930, actually. 15-year rolling averages, this kind of risk squeeze we're showing is going on for the rest of your life. Never happened. But it's there for a reason, right? That's what the regulators want us to do. In addition to that, we're showing the stress tests on top of that. So you've got something that's got a lot of conservatism built into it. But that's another side of that coin is if I'm projecting lowball, then my probability of overperforming goes up. And we want that to be the case, right? We want it to be better than we thought it was going to be. So that's why we built so much conservatism into this design. So if I can find my mouse, where does this take us? In a normal condition where we're showing even more squeeze than is normal as our what we call a normal case, Kai-Zen has a very strong value proposition for most people. Not everybody, but for most people.